these African economies. All retailers really just do not have enough cash. So the demand is there, and because the demand is there and you don't have enough working capital, you end up losing the opportunities in the market.
The guy is so busy at his shop serving customers, right? And, spending 30 minutes doing another process, that's a lost sale.
They're not interested.
And so, like such unique design problems can actually really affect the product.
For instance, for Unilever, we are sitting on 13 years data. 13 years. And we know every single order to the detail of the order for all the outlets in the country, which are almost 100,000.
Welcome to the S Squared podcast. Today's episode goes right to the heart of African commerce. We're unpacking how goods actually move across the continent, not the textbook version, but the real route to market that gets a bottle of soda or a bar of soap from a factory into a neighborhood kiosk. With Fred Njogu, Chief Operating Officer at Correlaction and a seasoned operator from Coca-Cola and Unilever, we explore why African supply chains look the way they do, why you can't simply build a warehouse and expect retailers to show up, and why distributors still face working capital gaps even when retailers are paying in cash. We dig into the hidden drivers of credit at the last mile, the razor-thin margins in informal retail, the risks of double financing, and what actually makes supply chain finance programs succeed. This is a conversation about how Africa's real economy truly works. Let's dive in. So thanks, Fred. We've been talking on WhatsApp for close to 5 years.
Yes, indeed.
We've been meaning to meet, but now we're meeting in a podcast studio.
Can you imagine?
Karibu sana.
Asante.
No, I really wanted you to be on the show. I think supply chain, how value moves through supply chains, and supply chain finance, especially like that kind of last mile lending, commercial lending, is a huge topic. A lot of companies have raised money on the back of this kind of theme, but there's also been a lot of like dramatic failures.
Absolutely, yes, exactly.
And so I wanted to have you on the show, especially because of you've got a very long background in FMCG across the continent, and so I thought who better than to have you on the show. So welcome.
Thank you very much.
Yeah. And
Samora?
I'd like you to just now intro yourself, tell us who you are.
Okay.
Yeah.
Very good. So I'm Fred Njogu, currently Chief Operating Officer at Correlaction. And I like to say that I'm a reformed engineer. I started my career as an engineer for Caterpillar, then went to Unilever, Coca-Cola.
Okay.
And then I saw the light. So now really running the operations for Correlaction, which is a B2B supply chain finance business. And we've been at this for the last 8 years. But our background is actually not in financing. Our background is in data and analytics. Before even the term big data became big data. Yeah. We were doing data for data analysis for our clients. So looking at all the data, EPOS data from retailers and so on, and trying to make sense and trying to figure out what the challenge is for them. And we quickly found out that the biggest challenge was actually the cash trap, especially in economies like ours, these African economies. All retailers really just do not have enough cash. So the demand is there. And because the demand is there and you don't have enough working capital, you end up losing the opportunities in the market. Yeah. And what does that do? It gives an opportunity for another person to set up the exact same business as yours. Because instead of consolidating to bring efficiencies, you actually fragment. And fragmentation happens because we can in our markets. Because if you open a kiosk, I like the idea, I'll open another one, nobody stops me. In the other, what I would call more organized markets, where financing not just for the produce, but general finance, not just working capital, but real capital.
Yeah.
Where it's available, they consolidate.
Yeah.
Because the markets reward efficiency.
Yeah. Yeah.
Here, the rewards are in fragmentation.
Yeah.
There is an opportunity, we split it.
Yeah.
Exactly. Yeah.
No, very interesting. I like that. Whatever. When you're talking about like access to finance, I think there was this show on Netflix some years back called Tinder Swindler. Did you watch it?
Yes.
The thing that shocked me about that show, of course, there was a lot of scandal. But like this lady actually went through digital apps and raised 250,000 euros.
Can you imagine?
And that for me showed me like just how financial markets work there.
Oh, yeah.
Like I need 250,000 euros, I can get it. But very interesting background. And that, especially that whole idea of like retailers and lacking finance. But before you get into that, you worked at Coke for many years, you worked at Unilever, you were in Nigeria, East Africa, Southern Africa. The thing for me is like, can you just map out how, before you go to the finance part, how supply chains work? Specifically, how goods get from a Coca-Cola or a Unilever or such a manufacturer to the kiosk, and why it's structured like that?
Yeah. So different markets in this region, in Africa, generally operate slightly differently. You'll find very well-structured markets like South Africa. It's normally from the manufacturer to a distribution center to a key retailer. So the Pick and Pays, the Spars, and so on.
Yeah.
They also have a route that goes to the Spazas, the Dukas, the mums and pups. Again, but they normally go and buy, distribute through a cash and carry. So it's like a big wholesaler, but it's cash and carry. Yeah. So those markets are that type of market is one type. Markets like Kenya, you find so the route to market is typically divided for FMCGs. I'm not talking about tires and stuff like that. For FMCGs. So it's divided between returnable and non-returnable, or one way. So 90% of the businesses are one way. So you buy sugar, gets in a pack, and it doesn't the pack doesn't come back. Or two way. So returnable. So things like beverages. You find alcohol, beers, a lot of soft drinks go that way. Milk also sometimes because of the crate. Okay. So the milk in a Tetra pack. So that's a two-way distribution. So that's one way of looking at it. Now inside that kind of distribution, there's always a distributor, and then there's an intermediary there who might be a wholesaler, and then the retailer, which is a duka and kiosk, mom and pop shop. Now, another key distinction is that there's a tendency to have, let me put it this way, there are markets that reward exclusivity. So you have you as the anchor or the manufacturer, let's say, or the importer. It could be. But you're the anchor. You have your distributors, and they're exclusive to you. They don't sell. They don't handle anything else. And then they service at a region, which has also territorial exclusivity. So you cannot come and sell in my territory.
And that's like the
Unilever, Coke, EABL, those ones. Because the size of business that they have in that category is so big that it makes it profitable for somebody to be exclusive. So if you are let me not use the word dominant, but if you have very high market share in the categories that you operate in, then you are able to actually set up a distribution system that's exclusive, and it makes money for the distributor. And from there now it's going into the retail. Retail, of course, is non-exclusive. And then you have the other one.
On that one, before, just hold that thought. It's a very interesting one. So, the likes of Coke, Unilever, of course, they've got large categories, and, there's a lot of demand for their products. And therefore, you've mentioned that they're able to now set up such exclusive distribution structures, right? But like for, let's say, let's call it Indian manufacturers, they don't usually have this kind of super organized retail type, exclusive. It's almost like come and get stock and
yes.
then you sell it, right?
Yes.
Is it a function of like my product is dominant in the market, or is it a function of like I set up as a small manufacturer and as I grew, I didn't see the need to create all these other complex structures?
Both actually. So you see, so the other companies we talked about, they have been in that exclusive distribution structure for years. So, and they've perfected that game, and that's what they do worldwide. These are the, let's say we call them the small dynamos, the guys that are coming up and really changing the market. Sometimes even taking leadership. Normally would start as a small manufacturer, and then even getting distributed is almost like a favor. So for instance, they have to sell goods on consignment.
Got it.
And then and so you cannot really set up. You don't have the structures to set up. You cannot make that distributor profitable if they're only handling you. But eventually we see them coming up. Now the setup for that exclusive distribution is really costly for you to be able to actually cover the market fully and make money for the distributors. So it's much easier for anybody to go through that trade, because then you have some very powerful wholesalers in the market, and wholesalers are aggregators. They'll pick whatever is on a deal. So everything that's on a low, where they make more margin, they move your product. So the problem is that then you don't have control at the final outlet. And that's a very important distinguishing factor, because the person who has control at the outlet then can grow their share. If you're working with a wholesaler, and they're good because they help move, they help move the market. But if they don't like you one day, or if they decide to buy cement or something else that has a deal, you never know actually who they sell to. You don't know the last customer, so you're stuck there with your goods. And so control is, I think, the most important factor for setting up an exclusive.
And that's why some of these like more traditional guys have been in the market for so long, and there's a lot of consistency around how you experience the product at the retail level. Like you know you're gonna get Coke, you know you're gonna get Unilever products. Whereas for some of these other guys, for 1 month you just go and the product is not there anymore.
And the manufacturer does not know who actually buys these goods.
Exactly.
So that aspect of control is a key one. Then the other key one is active distribution versus passive. So where you have a wholesaler who sits on a high chair waiting for people to come, and people just come, get a few cartons of this and that, and they enter matatu and they go. So he doesn't know where the goods go. Or active distribution, where now they actually sell out. So especially for where you have organized distribution, they actually sell out. So they have a route. So let's say today you're in Kawangware, and even Kawangware you can't cover the whole of it. So you have Kawangware route A, Kawangware route B, route C, like that. And this person calls on all those outlets at a regular frequency.
And I think that was there was this thing in Coca-Cola called right execution daily.
Exactly.
And so it was just, you have your routes and you whatever. And I think, why is that so important? You'd imagine like for Coke, everybody wants Coke. Or is it that the reason why everybody wants Coke is because it's always at the shop?
People used to tell me, you guys have the easiest job of selling Coke. Tell them, my friend, Coke, for instance, for Coke, they want everybody to have the Coke at 4 degrees centigrade within arm's reach of desire. I feel like taking a Coke, it's here. So it's in the next kiosk and it's properly merchandised. The stocking, the pricing, and all those things. You can only enforce those things when you have control of the outlet. So which means there's somebody checking that these things are actually being done, stocking levels, and so on and so forth. Doing innovations. When you want to learn an innovation, you have to have somebody that convinces the retailer that this thing is good. These are the margins. This is a profit story.
Exactly.
For an innovation and a new product. If you don't have control at the outlet.
And so it just shows that distribution it's an extreme science, right? there's a lot of hard work that goes to it. Even this thing of saying like, 4 degrees at an arm's length. I remember, doing some training, and this was, when I was in my past career, I had to build a agency banking distribution network. And I came to realize that, of course, Coke are like legends in distribution. So I went into like, how does Coke distribute? And I, spent some time with an ex-Coke regional sales manager walking me through the routes. And one of the things that I was astounded is even the way the fridge is kind of stocked has to be standardized.
There's a formula.
So like you have the Cokes at the top. I don't know, what else down
50%.
there. Exactly. And so I mean, it's really hard work. And then of course you then now see why it's so ubiquitous, right? And why it's such a successful product. But I want to know, now we've covered that. Is there any other specific detail about that kind of supply chain that you think is important, or we can now go into how money moves?
I think that's fairly good introduction.
Fairly sufficient.
The only other thing I would want to say, we've talked about Dukas and kiosks, getting there.
Yeah.
The modern trade, so the supermarkets, the hypermarkets, they are served through the model that I talked about earlier. The distribution center, so the anchor supplies directly to their distribution center, and then they ship out.
Yeah.
Or sometimes you supply to each outlet. So if you have 20 outlets, they supply directly, but it's straight from the anchor. There's nobody in between.
Yeah. And I think by and large you can say that Africa is predominantly informal. There are a few pockets of formality such as South Africa. And I think even Kenya is growing in informality. I think the supermarkets are making quite some good progress, but it's still predominantly an informal market.
Yeah, if you want to know, just go to, let's say, Kayole, on Masimba, or any of those roads. Every single inch of a street, the ground floor is a shop. It could be maybe a pharmacy, but predominantly they are shops, both sides. So and that's where the population lives, and everywhere else it's only so we have this penetration of really growth and the penetration of what we call the key accounts, but they serve 15-20% of
it's still predominantly. And I think I was arguing with a friend that you might have them growing, but if you look at where the population centers are, and I think one of the stats I saw is that in markets like Mexico, Brazil, South Africa, and a few other markets that are at least more developed, you find that the largest retail outlets have got, let's say, 3 times more outlets than the largest bank has branches.
Oh, yeah?
But like in Nigeria, Kenya, all these other places, the largest banks have got 2 times more or even 3 times more branches than the largest retail outlet.
Exactly.
So it just goes to show that, in as much as people say things are getting formal, like
you're still predominantly
informal.
Let me give you another statistic quickly. Kenya has way more retail outlets, shops, than the whole of EU.
Are you serious?
And so but for them it's a very developed market, so most of it is formal. So the number of outlets in Kenya is way higher than all the outlets in the EU.
And that's an interesting point. We'll come to that because it speaks to now some of this like supply chain finance things. But then let's talk about value. So let's say you're a Coke, you're an EABL. You have your distributors, and then the distributors now have their routes and the outlets and the retailers. How does value move? When now you want to buy, I don't know, 100 crates of beer or 100 crates of soda. How does the payment work, and how does it flow down all the way to the retailer?
Yeah. So most of these large anchors have some terms with their distributors, especially where they have key distributors. So they give them a few days to pay. So they give stocks, and then they get paid back within maybe 7 days, 5 days, something like that. And then those people, so the distributors, go and sell to, let's say for EABL, they sell to the bars on cash. But they don't actually handle physical cash. So that's another key thing for them. that all the business is cashless. And a lot of these businesses have visibility of those payments. So you find I, as an anchor, I can see that outlet has paid you this much.
Yeah.
So whether it's and because they don't want to handle cash in trade because of security, and also the benefit of having something like mobile money. It's a lot safer. It comes at a cost, so it's a cost to everybody. So the outlet sending money, the distributor, so the outlet has to pay to the distributor mostly by mobile money, or sometimes a transfer if it's a big wholesaler. It's not, the limits are, the amounts are too high. Yeah. And then from there to the anchor, from the distributor to the anchor, also electronic. Let's just put it that way. Yeah. It comes at a cost because cash trades at parity. 100 shillings is 100 shillings. But when it goes to mobile money, it's 98 or whatever it is.
Exactly.
So, but it's a lot safer and a lot easier and a lot more traceable. So you can actually see where value is coming, and therefore, again, it leads to that the same aspect we're talking about, control.
And so on. And you know, a brand like ABL is unique in the sense that I understand that they kind of even like control the distributor's account. You know, and you know, this bank guarantees that secure that 7 days or even however long it is. Yeah. And so it's like really tightly controlled. And you could say that it's not the typical supply chain, right?
No,
it's a very unique one.
Yeah.
So it's super organized, you know, very efficient. But then now there's other supply chains where, you know, the distributors can even be given up to 30 days. And then when you go down to your kiosk, right, the distributor is incentivized to give
extending credit.
So how do those things work, and what type of products or what type of manufacturers?
I think all of us, when we were growing up, we had that kiosk.
Yeah.
And it had a book.
Yeah.
And then you go and take things on credit, and you write on the book, and then at the end of the month, or when your parents get paid, they go and settle.
Clear.
So credit is being extended right from the outlet. And as a result, the distributor also extends credit to the outlet, usually in the form of a consignment. I'll leave you with these 10 cartons. When I come back, we count how many are remaining. You pay me for the ones that you've sold, like that. And then for the manufacturer or the anchor extends credit. So there are two things there. Sometimes it can be structured in the sense that we give you 7 days or 14 days or whatever. But then there's also the reality that if you give somebody 14 days, let's say it's a big wholesaler, and they give you a post-dated check, and then they tell you, don't bank it. What will you do? So they literally give themselves extra days. Yeah. And by that time, you know, they've already sold everything. But they extend because they can. Especially, I've seen this a lot in the pharmaceutical industry. So pharmaceutical industry is a weird one because they don't have exclusivity. Yeah. And therefore, if let's say I'm coming to buy Panadols from you, I'll buy the stock that I need, and then I give you a post-dated check. And then the next time I go and buy from these other distributors, the same Panadol, for instance. I'm just using that as a simple example. Until I've gone through all the distributors, then I come back to you and tell you, okay, bank the check now and give me some more Panadols. You know? Yeah. So it's a very... just because everybody sells almost everything, and also because of the replaceability, one drug can be replaced with another. Yeah, it has very extended credit periods. Yes.
And now, so in such a case, let's say it's not pharmaceutical. Let's say it's, I don't know, just like a typical fast-moving good. So your manufacturer gives the distributor, let's say, 14 days, right? The guy finds ways to extend it, let's say, to 21 days, right? But in this period, typically, he's already given the retailer the goods, and the retailer, you'd imagine that most of the sales, I don't know what percentage, but predominantly on cash, right?
Yes.
And so the retailer should be able to pay the distributor on time.
Yes, you should be able to.
Theoretically.
Yes.
Right?
Yes.
And so And so, if the retailer is able to pay the distributor on time, and the distributor, of course, that cycle continues, he gets the cash, he pays his manufacturer. Like, where does this, when you hear like retailers need credit, or like, there's a gap, there's a supply chain finance gap at the retailer's level, where is this coming from? Because my thinking is that, and I'm asking this out of like naivety so that we can get to the bottom,
Yes.
can get to the bottom of it. If the retailer, so again, in this 21-day example, you get your goods and you're supposed to pay this guy in 21 days. You provide the goods to the retailer, whatever's cash, and is able to pay you, let's say, within a week, right? If and let's say even for those 21 days, the distributor's gotten money from the bank, so that he's pledged his building and gotten a working capital facility to give to the manufacturer. Why does this retailer need money?
It's fundamental. Like, remember what I said at the beginning, that we fragment because we can. So a lot of these businesses are subscale. And also access to working capital is generally not easy. So what happens is that if there are some goods you must have in your shop for people to come. So for instance, if it's a kiosk in the neighborhood, you must have milk.
Yeah.
And the milkman comes first. They are very early in the morning. And bread. So if you look in your drawer and you have 5,000 shillings, you have to decide how much money you're going to allocate to milk and which brand. Because maybe you keep 2-3 brands, and how much you're going to allocate to bread. And the guy of soda is coming at 8, and so on and so forth. So you end up buying less than what you need, simply because you just don't have the capital.
Okay.
And for a lot of those businesses, it's not just a business; it's also your source of livelihood. So you're paying your rent, your school fees, and all that from that business.
Yeah.
So because you just don't have enough money, but you can sell. Let's say you have a construction site next door. You sell a lot of bread, a lot of soda, whatever at a certain time. You need to stock up for that. So definitely you could do with some credit.
Yeah.
Because then if you don't, somebody's going to open next door, and you're going to be 5 of you all of a sudden doing the same thing. That's why there's need for that credit.
So it's not really a supply chain finance issue. It's more of a working capital issue.
It's working capital,
right?
Working capital.
And then now, because I'd imagine, if you came to, and I think why it's an important point is a lot of people, entrepreneurs, they go to the Coca-Colas and the ABLs and say we can create like a supply chain finance product, right? But the way you've just mapped out the EABL kind of, and I'm using them as representative of a large established anchor.
FMCG, yes.
They're like, I don't have a problem with the supply chain, right?
Yes.
It's you who has a problem with it. I don't have a problem with it. And so the issue is not supply chain finance per se. The issue now is how to then now go into this kiosk and help them scale.
Yes.
Right? And I'd imagine there's many things, for instance, there's like seasonal swings, as you mentioned. Right now we're going into Christmas. And so there's going to be a big demand for sodas, beers, all that kind of stuff. And so that's kind of the working capital gap.
Yes.
Then there's also things like, expanding product variety, right?
Innovation.
Because, this other product has higher margin. It may stay in your stock for long, but you'll make more money from it than your other whatever's.
Exactly. It's actually an order to, it's an order to cash. It's a cycle. That from the time you place an order, it gets delivered, and then it gets invoiced, it gets delivered, and then you pay for it. That cycle. It happens instantly. The salesman is outside your door, and you look in your drawer. You've already allocated money for these other essential items, if I was to call them that. And then you actually, you can sell 2 crates that day. But then the money you have is for only 1 crate. So that's a trap.
Yeah.
So there's a trap there that you really need to fix. So really what you do is to smooth the order to cash cycle. So you can sell You can buy what you can sell tomorrow, not buy what you can afford today.
Yeah.
So basically, we are helping you fulfill the demand for your market, for your customers, without having to worry about finance. And as a result, when the finance comes through, it's just a consequence of smoothing that order to cash cycle. It's not intentional financing products. In fact, we normally say that our product, Top Me Up, is not a lending product. It's just a supply chain solution in that sense. It smooths that order to cash cycle.
Got it.
Yeah.
And so I think that's some really good clarity. And I think with that clarity now we can go into like what you guys, what Correlaction have been doing. My understanding, for instance, you began, there was a kind of partnership with Unilever and I think KCB or
yes, and KCB
and it
and
was
MasterCard.
And MasterCard, and it's called Jazaduka.
Yes.
But now the way you've explained it, like, did you even need Unilever to start with? Because why was it structured like that? Because as you mentioned, for Unilever, everything is organized, right? So why was it important for them?
Because let's say a company like Unilever is a market leader, but they would benefit a lot in share growth. So they need to grow their share, and one of the ways of making them grow their share, so that when the retailer because if the product is in front of the consumer, the consumer might prefer their product to a competitor product.
Yeah.
But if the outlet is not able to stock it, then
they lose on that.
Lose on that sale. So first for that, secondly also to just empower their customers to grow. So if you handle Unilever products and you join this program, you're likely to grow.
Yeah.
And we've seen that consistently. The really small outlets grew very fast, 70% year on year.
Wow.
And eventually now they are 15% year on year growth compared to the ones not on credit.
Okay.
Unbelievable.
Okay. Yeah.
So for people like them, why we needed them is because we don't know those customers ourselves. They have the data. Right now, for instance, for Unilever, we are sitting on 13 years data. 13 years.
Yeah.
And we know every single order to the detail of the order. For all the outlets in the country, which are almost 100,000, to how many packets of Royco Cube beef, and so on like that.
That's pretty impressive.
Yeah, so it's really big data. And but more importantly, we know there's an outlet called, let's say, Jins, or like in Kenya, the easiest names are Baraka Shop, Fair Price, Beipoa. There are many of those. So, but we know now you can go to one market and find 3 Baraka shops. So you need to know, in fact, which Baraka shop are you talking about.
Yeah.
So, the GPS, the geo coordinates information comes in, the outlet code, so that you're able to distinguish.
Got it.
And so on and so forth.
Got it.
But their data goes, and then their purchase history. But their data goes to that extent. I mean, they have a lot more, but as far as you're concerned, what we really need is that, and then who is the salesperson that services it, which is the distributor that services it. And we are also able to track from the outlet now. Sometimes you change distributors, or you change distributor regions, etc. So we are able to weave through the history to still maintain integrity about that outlet. So we need them for that, to introduce those outlets in a way that we can.
And that's also a huge one, because my understanding is that KYC and identity is such a huge risk in this kind of business. So they came and basically took that risk off the table.
No, actually, so they keep also because of the data protection laws, etc. It's not in their interest to store such information about it, because if there's a leak, then they're liable. So they have the business part of the data that we need. So the history, trading history, the name, the name of the business, the location, that kind of stuff. And that helps us do credit scoring. So we score them based on their past purchase history. Because again, if you go to the outlet and ask them for their financials, they'll find them on a piece of notebook. Yeah. So we need that. But then we know, so they sell to an outlet. We lend to an individual. So matching those two means we have to collect the KYC. Yeah. And typically how we do it is that, and that's the benefit of working with these companies that have control at the outlet. We use their sales force to recruit. Basically, it's a force multiplier using their sales force, because that person knows, that sales rep who visits that outlet every week knows this is the owner, this is the owner's wife or owner's husband, or that's an employee, and they are supposed to recruit the owner, because eventually we are going to give a loan to a person, and they are responsible to make sure that the payments happen. So so there's the business information that comes from the anchor, and then there's KYC, personal information, that we collect using an app. So we load our Salesforce, our sort of SFA, Salesforce automation system, that helps us collect that data that we need, including geolocations, etc. And we pick that up and match that with the business information that we collected from the anchor. And then that gives us a full lendable profile.
And so, you are coming with a data analysis bit because of your history in big data analytics.
Yes.
Unilever comes with basically their long history of, world-class data collection at the retail outlet, but also the infrastructure, which is quite impressive. And then what KCB now is coming with the balance sheet.
KCB came with the balance sheet.
So what's MasterCard doing in all this?
So MasterCard was doing so we were using their payment rails. So we were working with their payment gateway, MasterCard payment gateway. So remember, you need a device to hold that value, that credit value. It could be an account, it could be a wallet, or it could be a virtual card. So we gave everybody a virtual card. And the credit limit that we calculated was placed there as your typical credit card credit limit. And then every time we ran a transaction, when we financed a particular order, then we'll debit that limit and pay the distributor. And then the outlet owner is required to settle it after.
But I'm sure that put just a bit of friction, because these people used to cash mobile money.
Yeah.
So how did that work out, especially?
Oh man, that was quite something, because it's not it's a credit card, but we are not really giving credit. Number one. Number two, it's a virtual card. So you remember cards are 16 digits. And they have a CVV and the expiry date and all that information. The first design problem was to make it much easier, because nobody could remember their 16 digits, especially with a lot of zeros in between. So now we worked with the bank and Safaricom to make an SDK, so that we made an alias. So your phone number is your account number. So there's an alias, there's a relationship between your phone number and the card number. So when you pay into a Safaricom pay bill with your phone number as the account number, then we are able to
track
know how
that.
Yes. But then now it means we are moving from the customer has to go to deposit money into their M-Pesa wallet, and then from M-Pesa into the MasterCard payment gateway. Then from the MasterCard payment gateway to the bank. Within the bank, there are like 4 other processes, 4 other systems before the value is created, and it could break at any one of those.
So it's an interesting solution, but there are so many now, like hoops in between. And one thing I learned from my experience in building these networks, there's something called a till environment, which is like the guy is so busy at his shop serving customers, right? And spending 30 minutes doing another process, that's a lost sale.
They're not interested.
And so like such unique design problems can actually really affect the product.
Yeah, they can sabotage the product. And then sometimes you get, because these guys, there's a very good relationship there's a good trust relationship between the sales rep and the outlet. To an extent that they come and tell him, you load, here is cash, go and load it for me and pay for me. And then now there you start introducing
new risks.
Yes. So, yeah. And then also, of course, there was things about the culture, the behavior. A lot of these outlets the outlet owners have never had a credit card before. So the typical things, they are not used to, statement date is this, and then there's a grace period of this, whatever, and then we debit, and if you don't have cash, there's a penalty and interest and all. It's a really sophisticated product.
Yeah.
That was probably not ideal for that target consumer.
Yeah.
And for those and many other reasons, we decided to transition it to an account-based. We still use mobile money, M-Pesa quite a lot to move now from the retailer's wallet into our till, and from there it's just one transaction, and then we are good.
Got it.
Yeah.
And because the thing is I'd imagine, like, when you mentioned that you have a grace period, then charges, and when people start seeing those charges,
they get very angry.
It's very angry. I was speaking to someone on this show some time back, and he was explaining to me the reason why South Africans, they get paid, they withdraw their money on the same day. And it's this culture of, like, you don't know what charges could be in the account. Yeah. You don't know what kind of, like, debit orders might be in the account.
Let them find nothing.
Let them find nothing. But it speaks to the same problem. You're just seeing money getting out. And, of course, with your distributor, he also extends money, but there's no cost to that extension,
Yeah.
But then it goes into now the idea of margin. Like, some of these guys are making razor-thin margins on these things, right?
Yeah.
So how do they even afford interest to begin with?
That's a big problem, actually. At the distributor, it's even a bigger problem at the distributor level, because their margins are really thin, and they have serious investments.
Yeah.
So trucks, you have to have trucks, you have to have tuk-tuks, you have
and
to have
OPEX.
Yeah. So, and then you have those are financed by a bank somewhere. So when you find most anchors work on a slightly different model with them. So it's a model where I have to make you I guarantee you a certain return on investment. So because my goods might not move, or maybe I'm out of stock or whatever. So they work mostly on an ROI. I'm going to guarantee you this ROI. You do this, make these investments for me. Yeah. So for them, it's really tight. At the retail level, it's tight, and that's really, again, why we want to come there. We want to make sure that these people can access funds at the lowest cost possible. Because if you look at big retailers, the Carrefours of this world and so on, their operating margins are at around 2%.
Yeah.
So you can imagine that kiosk obviously is buying at a higher price. Therefore, his operating margin might be even less.
Yeah.
So we want to level out the playing field for them, so that they are not disadvantaged because of their size or informality and so on. Yeah.
And it's interesting, because when you've kind of mapped this out, what is very clear to me, and I don't know, but it seems like to get this thing right, you need to know the business very well, right? If it's Baraka shop, for instance, you need to know, number one, like the owner, whether there's a person of integrity.
Yes.
You need to, because, like, even on the data part, if you're saying that these guys can do more, but you're relying on data to score them, the data is not going to show you that these guys can do more, because it's historical data.
Yes.
Right?
Yes.
So you're going to see historical data. This guy's been doing, let's say, 5,000 bob per day, or let's say 1,000 bob per day. You're not going to see anywhere that shows that this guy can actually do 5,000 bob a day.
7,000.
7,000, right?
Yes.
So the only way you can know that is if that sales guy tells you this guy actually can be doing 7K a day or something like that, right? Basically to know the operational capacity, the character of the owner. And it just goes back to almost traditional lending, like some of the things you need to know about about a potential borrower.
Yeah.
So that now you can say, okay, this, today he had 5,000 at the till. He paid his bread guy, he's paid his milk guy, he's paid his coke guy, but I know this guy needs 10K, so let me give him an additional 5,000.
Yes.
That's where you need to go to, right?
Exactly.
So how do you build those capabilities?
So there's quite a bit of science behind it, actually. Like I said, when we first brought some of, especially the really small customers, who even the distributor never bothered going to, or goes once a month, because it costs them a lot more money to go there and deliver. When we enable them, because what it means is that the distributor knows, because maybe I take a step back. The distributor wants to make sure that whenever he stops, he drops and gets paid. So somebody came yesterday and booked orders, but then today I come to deliver, and you are saying you don't have money. I have to return those goods. So there's back handling, etc. So they don't want that, and they've wasted time. And their time in outlet is a very key metric for FMCG. So the first thing that does is that it makes sure for the distributor you are guaranteed those credit customers. You'll drop the order there. That's the first thing. So they are very keen on that. The second thing for the distributor now is that there's some unit economics that we have rule of thumb. So if you are distributing in a 3-ton truck, the scanters and whatever, your minimum drop size in an outlet for it to be profitable, that fruit needs to be at least 1,000 shillings, or let's say $10. So if you go across many markets, about $10. If it's
and that's the order value
minimum. If you're dropping anything $700, $7, $6, it's unprofitable. So if you have a pickup or a tuk-tuk, depending, and then those trucks cannot go everywhere in our markets. So you need to have maybe a tuk-tuk or a pickup. Again, that's about $5 on average. We've studied this for a long time. It's about there for it to be profitable. And then if it's on a motorbike, it's about $2. If it's a bicycle, $1. No, motorbike, $2, $2.50. Bicycle, $2. If it's on foot, at least $1. So there are things that are distributed on foot. Let's say like sweets, confectionery. You just put in a rucksack and you move along. So one packet at least, because in a shop you'll not sell half a packet. You don't open the pack. So one packet will be there almost $2. So at least when you pass there, you've made money for yourself as a salesperson. So the unit economics, first of all, tell us that some outlets get disadvantaged because what they want to order is half a dozen. Nobody will bother. So they end up having to go to the wholesaler where they can buy half a dozen. They can go 3 times in a week for the same thing. So so coming up with the limits is a
it's a science.
It's
an art and
a
a
fuzzy logic. So we just decided to give these people, because we have seen consistently this is what they are selling. We decided for the retailers, for the small retailers, we decided to give them 5 weeks cover, 5 weeks. But we know, so if you're buying 1,000 every week, instead of giving you a limit of 4,000, we give you 5,000. And because we expect, and then we see how you grow. So if you grow by 25%, in that month, you'll have reached your limit. And then the next month we review. Every month we keep on reviewing. And we've somehow got that balance right. Because then what that means is that we are able to match your growth. We don't want the sales rep to load you because they know you have credit, because then you'll be unable to pay, and then you get into default and all the bad things that happen after that. So we've got it to a science.
Interesting. But basically, it's a trial and error. It's an iterative process.
Yes.
the thing that arises is that, Fred, like now with digital lending, M-Pesa, Fuliza, I'm sure Fuliza, all this kind of things, right? Money is fungible. There's no difference between this loan and this loan. Like money is money, right?
Yeah.
So when all these digital loans are there in the market, how then do you guys, or anyone who's in this business, monitor things like double lending and, over lending? Because you can fall into the trap where now you're lined up with everyone else, right?
Yeah.
You've done all this work. You've figured out that a tuk-tuk is $2. You've done all this work. But ultimately, when it comes to now repayment, you're lining up with the Talas and the Fulizas of this world. How does that work out?
Okay, so it's a sort of a roundabout solution, because what we've done then is that for us we choose our anchors very well. So they need to be people that really sell essential. Let me not say essential in terms of consumption, but the best products, because then you as a retailer will want to make sure you have those products, and that's the one thing. And the second thing is that those people have an exclusive distribution system, so you must buy from. You cannot decide to wake up and go and buy beer, let's say from. It has to come from the truck. For instance, or sodas from, So once you have that, then that person will make sure that when to a large extent we get very good compliance, they'll make sure that they are able to buy tomorrow, because that's their business. So they pay. Then also we have a very complex set of tools that we use to ensure that we get paid. We monitor the transactions. We have connection directly with the sales reps device, so we know when they're there, we can put caps on how much they can sell, etc. And we do this. It's even if I'm the one saying, I know it's a really good set of systems, many of them, including some smart contracts we have with the anchors that basically they cannot sell to somebody who we've told them that this person is owing us money, etc. Those kind of things. So, and for that reason, then we are very cheap. We do 1%. Nobody else does anything like that. So because of all those things, we come in at such a cost that it makes sense for anybody. And then for some anchors, because they grow, they see when they're with us, they grow, then they're happy to take up that 1% because it gives you 15% growth. Makes a lot of sense.
And now for you guys, is it that now, like from a commercial perspective, is the goal to increase the number of anchors, onboard more anchors? Is it to now go deeper within a specific, let's say, anchor relationship? Like what drives the best growth?
Both. So the more the anchors you have in an outlet, basically your share of that outlet's wallet, the better.
And the more data you have.
The more data you have, but also the more control you have. Because then if I cannot block you for Coke and leave you open for it's an account, so you block everything. The guy will be incentivized to pay.
Yeah, he has to pay.
Yeah.
But what's becoming very clear, when you introduced this thing earlier and you talked about the fragmentation, and there's fragmentation across, right?
Yes.
So even at that anchor level, someone can go and start his own brand, right? But then what happens is that the entire supply chain gets disorganized. But what's very clear is that a Unilever, a Coke, an EABL, with the kind of control and data they have, they can actually drive more economics into the into the outlets, right? And given they're organized, then it means that partners such as yourselves are even incentivized to kind of come in, right?
Yes.
So you find that now that creates order, but without that order, then everything falls apart, right?
You can't operate.
And that's why that goes to show like why this kind of supply chain finance or kind of retailer finance really depends on an organized supply chain.
Yes.
And if you just have an extremely disorganized, and that's why, some of these banks won't touch, even if it's a 30-year-old manufacturer who's been operating in the industry, but he doesn't have an organized supply chain, then he can't incentivize anyone to touch it.
And actually that's what you see. Many banks are willing to lend up to their distributor, but not beyond, because they just cannot. They don't have control at the outlet, so they have nothing that they can hold. So if I come and lend a kiosk 2,000 shillings as a bank, I have to send a relationship manager to go and collect if this guy doesn't want, or I have to send them to the CRB, list them and so on. So for them, it's a bit the amount of detail that we have to be able to manage that outlet, to make sure that they pay, or to make sure that they operate properly. They just banks wouldn't bother.
And if even the whole idea of maybe to a Western audience listening to this, a $10 order value for like a shop, that's even smaller than what order values on Amazon, like way smaller.
Absolutely. Absolutely, yeah.
So that just goes to show like how difficult it is to get it right.
Yeah.
Now you said you have a product called Top Me Up.
Yes.
Just what's the difference between that and Jazaduka?
Okay.
The nomenclature, all that.
Yeah. So when we decided that the card-based product was quite complicated, and Mastercard, by the way, are still our partners, KCB are still our partners, but now the relationship is not the lending. It's not that retail lending relationship. It's a different. It has morphed. We decided that because we had quite a bit of bad experiences, we decided to we looked at everything. What are the challenges that these customers were facing? What are we facing ourselves as a operator of the system? What was the bank facing? All those issues. We came up with another product now called Top Me Up. And the reason, Jazaduka was a very good name, especially because we were going basically to fill up shops, small shops.
Yeah.
But then we moved to Uganda. There they want to say Juzaduka, for instance. You move to Burundi, Rwanda, it doesn't mean anything. So we decided, let's go with Top Me Up. Because also not only across markets, but also across categories. So if you're in, for instance, we have a product for fuel where we finance SACCOs, Matatu SACCOs, to fuel up. So Top Me Up makes more sense for them than Jazaduka. I mean, it's or let's even in a pub, Jazaduka doesn't. So that was it really in terms of why we decided to go with Top Me Up. We still own the Jazaduka trademark. We also own the Top Me Up trademark, but we feel that for our regional expansion and cross industries, Top Me Up is better. That on a brand name point of view. In terms of product functionality, also we redesigned all that. So we have a solution where we are able to debit a customer's account directly instead of waiting for them to push money to us. We work with, for instance, M-Pesa to be able to, what do they call it? Prompt customers to pay. We use a till. We have a pay bill, etc. So quite a big redesign on the product technical aspects, but also on the trademark itself.
And basically, this allows you to grow across categories. Where you're not stuck on the kind of this kind of retail thing, because that speaks to your fuel product,
pharmaceuticals, agrovets.
And that's what now should underpin the next growth for your business. Like, where are you guys right now, and what are you seeing now down the line?
So we are in Kenya. We went into Uganda, but then again, we need to relaunch the Uganda business. We move with our anchors. So our anchors tell us, I want you to do this for me also in Uganda, in Tanzania, let's say in Rwanda, Burundi, this region. So we target 14 key markets in sub-Saharan Africa, which we should be well in place in next couple of years. because once the anchor, especially these anchors who have good and consistent data across markets, then it becomes very easy to roll out. So that's where we see ourselves in those 14 markets, 2028. It's very ambitious.
It's very ambitious because Africa is
and something else.
It's very heterogeneous, right? Like you just cross Tanzania and things are completely different.
Regulators.
Yeah.
Those kind of things.
I was told by some guy about how, even distributing in Nigeria, there's the states, and like even crossing states, there's money to be paid. And so you go naively, like you can expand the product there, but like you're coming up with so many different issues. Now, which other products? Because when you speak about Jazaduk, I think Equity had done something slightly similar.
Yes.
Also card based.
No, theirs was actually account based. I think it's still there. It's called Easy Stock. I don't know how successful they have been, but because again, like I was saying, banks they just really don't understand that level, the last mile. They don't. They don't understand. So you need to work with your anchors very closely for you to succeed.
And those anchors need to have salespeople because what you're saying basically is that you get like low cost or zero cost relationship managers. That can now help you now manage that thing.
Precisely.
And there's incentives across because for them they can sell more. They can do all that. The route is much more profitable. But it's an extreme science, and it just shows why, supply chain is one of the areas that I see like highest failure rates in like digital lending, right? Just because there's so much nuance, and you need an operator, you need an entrepreneur, you need everything. Are you guys like raising balance sheets to do this?
Yes. So we have two cash needs. We have the OPEX, so equity investment in to be able to run the organization. We are quite lean actually. We are distributed. Our office is distributed across I think 3 continents. So a lot of the heavy lifting on especially data and tech is out there. We have a team here in Nairobi that does a little bit of that tech work, but a lot of the customer management, all the customer management is done here. So customer, we have 3 types of customers. We have the outlet and the distributor. That's one type. We have banks who we work with both to set up, APIs, integrations and so on, but also for lending. And then we have the anchors. So that a lot of that, those customers, I want to call all of them customers, those relationships we manage from here. I spend most of my time doing that.
And like between the time a loan gets out of your door and comes back, what's the average duration of that?
It's supposed to be 2 weeks, but you'll be surprised. It's around 11 days.
So very high turnover.
Very, very high.
Small amounts, but and I'd imagine good repayment rates.
Our repayment rate is, I think, industry leading.
So why you shouldn't have any issues raising money? Is it because of the low cost?
So first of all, it's very low cost. So our margins are not. We don't want to share that little margin with everybody. That's one. But also, again, a lot of lenders here really have a very traditional way of thinking about lending. They want you to have collateral, physical collateral. So mostly they want landed assets. And you wonder how much land you need to have to fund the loan book. So that's a challenge, and therefore we look at initially raised all the funds from shareholders, but progressively looking at more innovative ways of raising the funds.
No, I think the good thing is that the kind of credit markets for such products, at least in a different place now than the one, let's say 10 years ago. Like you're likely to have more productive conversations like that now, as opposed to maybe when you're starting out. The ecosystem has matured a bit. The only challenge may be the pricing, because when people look at Africa, You know, they have a specific IRR they look at for lending.
And work.
Exactly.
The average costs.
Exactly.
They have a number for every country.
Precisely. And so now when you're saying that the only way we can make it affordable to these retailers if we do it at this, that's where maybe you're struggling with some friction.
Exactly.
Yeah.
Although based on our performance, and if we decide to, like when we open up our market to look at, I mean the market for funds, where we are raising funds, if you look at Europe, if you give somebody a 12% return,
Precisely.
it's a very good return for them. So we can raise funds there. Luckily for the last year or so, the dollar has been very stable. So whatever they're doing.
But it speaks to the need to like deepen these capital markets in Africa because, one thing I've always said is that, when you run a bank or when you have proximity, they're not built for that type of lending. It's just not the way they're structured. And the big thing is the incentives, as I was talking before the podcast, the incentives for the credit guys, right?
Yes.
It's to avoid risk at all costs.
Completely.
And if my KPI shows even one impairment, there goes my Christmas bonus, right?
And the conversations become very tough.
Very tough. So that's why like you need, globally private credit is coming up. But to do private credit, you also need like local currency cash, available, whether that's the pension funds or
those are the ones. Fund managers need to step up to bridge that gap because there's actually even the other digital lenders. They need a lot. They need money. I mean, this market is starved of cash generally. So these people need to move away from just investing in stocks and equities bonds. And so on, bonds. Yes,
predominantly bonds.
Yes,
and that money is just being recycled. No, but this was really useful. I think you've really broken it down properly. And I think, I like when such conversations where someone breaks it down such that the insights are the most logical thing, like nobody gets confused. Like, how do they come up to that conclusion? So I liked how you've broken it down in terms of like the supply chain, the different types of manufacturers, the whatever, and specifically that cash gap. And it's a cash gap of like this business, if anything, needs to grow. Not exactly. That there's a working capital gap in the supply chain. It just needs to grow.
Yes.
And so it's growth capital per se, short term, that relies on knowing the customer. And I think those are the opportunities that need funding, because I was speaking to another guest, and it's like if you look at Africa is an SME market.
Yes.
Right? You're not going to have large, 1,000 large corporations.
No.
It's everyone just doing their thing and making their money. And that whole economy is illegible to the banks, and that's why you need the correlations.
Exactly.
Yeah.
Because now what we do, actually, we monetize idle assets. So their data is an idle asset. It's been sitting there. But now we can monetize it. We actually, it's what people call goodwill. Like you have a shop at a corner, a street corner. Let's say you have something in around Kencom there, or the traffic is very high, but who cares? But that when you want to sell that shop, you'll sell. I mean, the real value, and then you say there is a goodwill. That goodwill, this data is actually goodwill. So we monetize that. We free up. I mean, if you look at it in Africa, in the markets that we operate in, people don't need more tuk-tuks to deliver or more warehouses. Those ones are there. The system is there. And also people don't need more banks. We just need to make these two value chains meet. So you have the financial value chain and the physical value chain. And that's what you're doing. Just making them two meet. And when we come in, we need to make sure that we come in at a lower cost than the efficiency that we bring.
That you're unlocking.
Yes.
So that you've hit the nail on its head. Like if you're unlocking value but you're capturing all of it, then
there's no point.
There's no point, right? The retailer, everyone else has to benefit from that value.
Precisely.
Oh, thanks, Fred. This was incredible. Thanks for coming on the show. I knew it was going to be good. And that's why I've been looking for you.
Yeah.
But thank you very much.
Karibu sana.
Cheers.
This is very good. Thank you. I've enjoyed as well.
Asante.